Hi, this is Sandy Park with Hudson Valley Nest and Berkshire Hathaway Home Services, Hudson Valley Properties. Welcome to the world of loans. Today we are going to explore getting a loan, what's involved with getting a loan, considerations that you should take into mind when you are applying, and some tips for the process to get you started and ready for spring market. Today I have the Chief Operating Officer from TEG, for residential mortgages, as well as the Vice President of Residential Mortgages with Rhinebeck Bank to join us. So we have quite a bit to contribute here between our guests, and I hope that you enjoy it. If you find that you do, please throw me a like and subscribe to my channel. I have other webinars coming up in this series, all circled around empowering buyers and sellers. So without further ado, we're going to get started. I'm going to introduce our guests here. We have, let me pull up my slides. Okay, we have me, Sandy Park. Again, I'm with Berkshire Hathaway Home Services, Hudson Valley Properties, and Hudson Valley Nest. I've been a top selling broker for over 20 years. I started out in Westchester County, New York, and have been recently focusing my work in Dutchess County, New York. I worked through the bubble and burst of the early 2000s, as did both panelists that we have on today. I focus in residential resales, new construction and land, and I have offices in LaGrangeville and Rhinebeck. And then we have Vincent Origama. Did I say that correctly, Vince?
That's close enough on your first try. It's Origama.
Right. Vice President of Residential, have you over here? I can't see the whole thing. Residential mortgage lending. Is that correct? Okay.
Yes,
with Rhinebeck Bank. Vince has over 30 years of operations and sales management experience with the almost 20 years now focused in the mortgage industry. Vince is the immediate past president of the Mid-Hudson Valley Mortgage Brokers Association. And as a sidebar, Vince has been working with the high school basketball as an official for 18 years now. I'm assuming that has to do with your kids too also, Vince.
Well, it's kind of like being at home, because an official is like being a parent, because you're always chasing around teenagers. Half the people think every call you make is wrong, and somebody's always ready to yell at you.
And then we have Jackie Fellon here, who is Chief Lending Officer with TEG Federal Credit Union. Jackie went to Marist College and graduated with her business administration degree, local. Jackie has over 33 years of experience, including supervising 12 offices with a finance company throughout New England and New York. Jackie has been with TEG since 2009, and in 2012, Jackie launched TEG's in-house mortgage department. Jackie is also a member of the Mid-Hudson Valley Mortgage Brokers Association and has been a past two-term president and is currently the treasurer. So welcome, Vince and Jackie. I'm going to
thank you.
Welcome. So now just to kind of do a little introduction as far as the mortgage process is concerned before we get in with Jackie and Vince. One thing I will say is, we are in a heated market, especially since COVID. Where really, even before we were in this market, it was always very important to secure your financing prior to going out and looking for homes. But that is even more so now with the level of competition that exists among buyers for housing. So you really want to have your financing set before you go out looking. Two reasons. One is, if you find a house that you like, it is a competitive environment. You are going to need to have the proof of financing in order to really have your offer be considered. And the second thing is, a lot of sellers these days with COVID are not letting buyers even into their home to see their home without first showing that they have a pre-qualification from a bank. So all in, this is very good timing. Having this webinar now gives you timing to kind of get things going. But it's very important to get the financing straight. And you also will have a very good understanding of obviously how much you have to spend too. You don't want to waste your time and everyone else's time looking at houses that are outside of a price range that is not realistic for you. So all in, taking care of the banking is really step one in the process when you're looking at buying a new home. The foundational piece of this, where it really all starts, is with the credit reports themselves. The banks pull from 3 different credit reporting agencies. I'm going to bring Vince and Jackie in on this, but is important to know what negative entries exist on your credit report. That's foundational for what the banks are looking at when they're looking at your credit worthiness. And Jackie, if you want to add to that.
I do, I would say it's important to know that there are different credit score models that are used within mortgages. We pull a tri-merge credit report, and all lenders do use the same FICO model, which is different than that FICO model that you would be using if you went to apply for a car or for a credit report or a credit card. So, generally, if you have generally good credit, it's probably going to be in the same range, but there are differences with that. So I think that it is important, if you're serious about shopping for a mortgage, to have that tri-merge credit report pulled. So if there are any issues, you can address them promptly. And also knowing that that credit score that's pulled is good for 120 days. So if you do go out shopping, 3 weeks from now, and you finally found that house and your offer is accepted, you're not going to have it repulled again and again and again.
Now, one thing I do want to just clarify when you're saying the tri-merge. So there are 3 credit reporting agencies: TransUnion, Equifax, and Experian, correct? Is that correct? Do I have that right for the 3? Okay, so there's 3. Now, basically, all 3 don't necessarily mirror each other. Some can have entries from a place where another one doesn't. So if you want to actually take a look at your credit report before even going to the bank to kind of get an idea of where you stand, annualcreditreports.com is a place that you can go to get a free credit report if you have not ordered one in the past year. You can get all 3 for free there. Now, getting into the FICO score, Vince, I'm going to throw this out to you. As far as, so now you have these 3 credit reports, they merge, and from that you're getting the FICO score, correct?
Yes. Now, we're basically getting 3 FICO scores. And what we do is we use the middle. Okay. So basically, and Jackie's 1,000% right, and you're correct in this, Sandi, as well, as all 3, not everybody reports to all 3 bureaus. So the major financial institutions will report to all 3 because we understand how important that information is to get out for a borrower to build their score. Some smaller companies may only report to 1, which is why you're going to see variations in scores. But it's important. One thing, you mentioned Credit Karma or annual report, credit report, or freecreditreport.com. You want to use those really to uncover anything that's hidden that you may not know about. An old collection, an old medical bill, some things that may be on your reports, maybe a delinquency you didn't realize, or maybe there was misreporting. Something that's out there to uncover before you start to shop. But what's going to happen is those scores, as Jackie said, are not what we would use. Remember, that credit report, that FICO score, is meant to be a predictor of repayment of your mortgage. So it's going to take into certain accounts, certain liabilities that are going to be more important for mortgage payment, past housing, payment information. Sometimes we'll get people that come and say, well, my credit score is a 900. Well, in the FICO model, that's impossible. So because it doesn't exist. So it's really important, if you want to get that free credit report up front, that should really be to uncover or give you an idea of the things that are on your credit, but really go into a mortgage loan officer and dealing with a lender who can pull that tri-merge and speak in specifics to what is actually going to be used toward credit qualification.
Now, one thing I want to actually add to this too, that we discussed the other day together, was that the FICO score. So if you go onto a place like Credit Karma, just as like an FYI to everybody out there, the mortgage banking industry uses FICO 8, which is not necessarily what Credit Karma is using to develop their FICO score. So you may find a FICO score that's actually different from what you will be quoted from the banks when they actually do theirs. Is that correct, Jackie?
Yeah, no, absolutely. And also credit, it changes every day. That different lenders report different, they turn in their tapes typically monthly. They're not updating their records every day. So, if one lender, if I pull a credit report on March 1st, that may have TEG's most recent information through February, but maybe Rhinebeck's only reported through January. And credit reports are very, they change continually, because even your usage on it, if you max out a credit card, maybe you made a big purchase and you pay it in full, that 1 month where you're near your limit, it is going to impact your credit score. But then that next month, when you've paid it down, it's not it's not going to be a concern. So I would say definitely, if you're looking to apply for a mortgage, you want to keep an eye on your capacity, and that's the balance of what you owe to what your credit limit is, because the FICO does not know how much money you make. FICO just knows how you manage your credit. So if you have $10,000 of credit available and you use $10,000, they're going to say, gee, something might be wrong. You've used every little nickel that's available and you have nothing available if something comes up. So they're going to read that as a negative. So generally, keep your credit limits on your revolving below 30% if you want to have the optimal credit score.
Okay. Now, when you're, let's say you've got your credit reports, you're going to the banks. Now, as far as, there could be a difference in a very small percentage point between banks, which could equate to thousands over the term of a loan. So, I do encourage my clients to at least talk with some different banks. I mean, obviously not, a gazillion, but to talk with different banks and get an idea of different packages and rates and things like that. In the course of doing that, is there an impact on the credit that happens by a person going from one bank to the next and having these credit reports being pulled? Vince?
Yeah, that's a great question. There really should not be. And remember, there's different types of credit pulls will affect someone's credit differently. And as Jackie mentioned, capacity is a big point. So if you're going out and you have multiple credit card inquiries, that mathematical model kind of says to itself, hey, there may be something wrong with Vince's cash flow and that he needs to search out credit in order to maintain his monthly bills. That's why you want some room in capacity and how much you can borrow versus how much you have borrowed. But you generally want to group your inquiries, especially when you're talking about mortgage financing. Don't be scared of a credit pull, but there's no reason to have 4 or 5 of them. As soon as you have one and you know your score, and here's one thing that's important: a lender can't give you the credit report. We can tell you what's on it. We can review it with you. We can't give it out. We've contracted with the provider. We're not a credit agency, so we can't give you the report because people ask a lot. But we'll be able to tell you the score. And with the score and your liability numbers, knowing how much you owe, you have power then to determine debt to income and understand what program that you're in. Now, credit score is dynamic. So if you apply someplace a month later, as Jackie mentioned, your score may change, but at least you have a range to know, hey, listen, I've got a 701. If I have a bad month and I drop below 700, I may have other agency fees that apply. So there's different levels that you want to attain. Obviously, the higher, the better. But those could change. But as far as inquiries, get one and then shop with lenders to get a comfort of who you really want to work with. And then you're going to have another credit inquiry, but you don't be scared of them, but you don't need a whole heck of a lot.
Okay. All right. Now getting into the pre-approval. So now, you've come down to it and you again, the starting process for really going and looking at homes is to get that pre-approval first. So that, again, what's a comfortable range that that you have to work with, and also to show that you have proof of finance to a seller, so that if you find a house that is something that you want to pursue, your offer will be taken seriously. A seller is obviously, going to have a little bit of a hard time taking an offer seriously if the buyer can't prove that they're in a position to buy, especially in a market like this when we have multiple buyers coming to the table on different houses. So financing is key. So getting that pre-approval, and I keep saying pre-approval, pre-qualification. So to be clear on this piece of it, because pre-approval and pre-qualification have been used interchangeably, not interchangeably, actually. Pre-approval has always been thought of as like, looking at the credit reports, looking at, the work history, and issuing a pre-approval based on that. Pre-approval, pre-qualification has been thought more along the lines of, you told me this, so we'll give you that. So, what I'd appreciate it if maybe Jackie, you can kind of give some clarity on that, give clarity on what that if it's a pre-qualification, what is that pre-qualification? What's been looked at to get to the point of that pre-qualification?
Generally, I would say a pre-qualification is you've got your mortgage loan officer who is reviewing the information that's provided by the borrower. I would say 90% plus of our applications, the borrower starts and just fills out their information with a quick online application. It makes it a lot quicker for borrowers that, this way their interaction with the mortgage officer is more based on sharing information instead of saying, and how do you spell Gemma? And what is that? Is that 2 M's or 1 M? So I think that the borrower is going to complete the application. In 2021, we're looking at most are started online. Vince, you might disagree, or I don't know if that's how a lot of yours are going. At that point, we're getting the borrowers disclosing their income, they're disclosing their assets, they're disclosing how long they've been at their job, they're disclosing if they're a salaried or an hourly employee, they're disclosing how much commission income they have. All of these things go into that initial application.
And now I'm going to stop you there for a second. What type
Yes.
of documentation is actually requested at that point from the bank? What is actual documentation requested?
We do, at TEG, our online application will prompt you to upload your pay stub, your bank statements, a fair amount of additional information. And the more that information that the borrower actually provides us, the more that we can review.
And Vince, is that the same for you? Do you guys also request this type of information out of the gate?
Yeah, it's requested but not required. And, this goes into a little bit of the complexity of a borrower situation. And I'm sure Jackie's seen plenty of these too. We get a lot of the online applications where someone makes, $120,000 a month instead of $120,000 a year. So we have to be very careful with what we see online. We always verify because we don't necessarily trust that what somebody enters online is the appropriate information. They may have just kind of penciled it through it and not realized month per year. But if you have someone who is a W-2, and I think we Chad used the example of someone who's a teacher, and he or she makes X number a year, and we know in confidence they have that. We're not necessarily going to ask for off the bat W-2s, pay stubs. We know there's a contract set amount. We have confidence that number we can use. If you're self-employed, own several businesses, we really need to dive into your tax returns, depending on how long you've been in business. It gets much more complex. So there's different levels that we'll ask for depending on the complexity of the borrower. But yes, upfront, and as a prudent course, if you're in the market to look to buy a house, you should have a firm knowledge of how much money you make and
Yes,
what to provide.
and also how much assets you have. And that if you tell your mortgage officer about your income and you tell your mortgage officer about your assets, you are going to be expected to be able to provide that documentation to verify that. So, these conversations, well, I really make, or how much money do you have for a down payment? How much money do I need? They're silly.
Okay, and the reality is, if people fill this out online, right, and they give you some documentation, maybe they don't give you all documentation, but let's say you go with what they've said for some pieces of it. Maybe some pieces of documentation haven't made their way to you yet, and so you're trusting to a certain level what they've put. But at the end of the day, the reality is, whether it's right then or 30 days down the road, the bank's going to pull everything. Right? I mean,
yes,
the bank's pulling everything.
Everything's going to be verified.
So a really big lesson here with this is to be straight out of the gate, because at the end of the day, if a bank says, we'll give you X to buy based on a pre-qualification of information that you've provided to the bank, and then 30 days later, all of a sudden the bank is saying, all right, you know what? You didn't provide these different pieces. Now you need to provide that. And those pieces don't jive with what you said in the beginning. It's all bets could be off. Yes.
Absolutely. And one of the biggest areas that I've run into recently, and Vince, maybe you have not seen this, but in terms of declarations, we ask people if they've had any foreclosures in the past 7 years. We ask people if they've had any liens or judgments. We ask people if they're a citizen or a resident alien. All of those questions are important that they be asked correctly, because foreclosures oftentimes don't show up on credit, particularly if you had a borrower who had a previous bankruptcy and was paying for things. But as we go through our processing and our due diligence, and we do pull a lot of reports at that point, they show up. And that's something where, had people been upfront, and, just because we don't see it doesn't mean we won't find it, because I can tell you we will. So if there is an issue, you need to be upfront with your mortgage officer from the beginning so that we can get somebody into the correct program for their situation. And I think that that's a big part of it, that we're all on the same team. We all want to get that borrower into their house. We all want that mortgage to get closed, whether it's a purchase, a refinance, whatever it is that somebody's looking to do. And the better the information we have from the beginning, the easier that process is going to go, and the fewer frustrations there are going to be.
Okay, so that's
a find out.
that's a pitfall tip you're giving there. Pitfall tip to avoid. So this way, if you just straight out of the gate provide the information, things can go a lot smoother in the process.
Just real quick, I liken it to treating your loan officer maybe one step away from being a therapist. You really have to come clean with everything. We're not looking to spend your money. We're not looking to increase your payment, put you in the wrong program, but we have to know what's going on. Jackie's dead set on the mark when she talks about those things that are coming up. And the problem with those, the biggest problem is they never come up until the end, once you get the title with bankruptcy searches and those type of things. So that wastes a lot of time.
And money, because because buyers, there's money that's put into these processing fees. There's money that's put into these appraisals and all these different pieces where, you could be putting time and money into this as a buyer to then find out, well, if you didn't disclose, right?
And I mean, even home inspection fees, your lender does not want to see your home inspection. Believe me, we do not want to see your home inspection. But you're going to be hard. I would certainly say that 95% of the buyers we have spend money on a home inspection.
Yeah, and it's a noticeable amount of change that they're spending before.
So why are you going, that if there are issues, I think honesty is the best policy. And
okay,
if things aren't disclosed, they're invariably discovered. Even just other properties that people don't mention that, oh, you know what? Yeah, I do own a lot in Pennsylvania, a vacant lot, or I have a second home in Florida. That all of that stuff comes up. And if it's not disclosed, it does add an extra layer of complexity to gathering all of this down the road.
Okay. Now, you're looking at, let's kind of get into the self-employed. I'd like to really touch in on some changes that have happened in the mortgage industry with processing since COVID, different things that you've noticed as far as the process is concerned. I know from experience that I've had with my clients, the title companies have been backed up, the appraisers have been backed up, banks have been backed up, because it's just the amount of, the amount of work that's coming through. But stepping back from that, when you're looking at somebody that's self-employed, for instance, what are some differences that you've seen in the industries, particularly since COVID? And Vince, why don't you answer this one as far as self-employed, what have you seen as differences and requirements or anything since COVID?
This is where we've seen the biggest change as far as the agencies. When I say agencies, Fannie Mae, Freddie Mac, and the guidelines, FHA, the guidelines required for approval with income. Generally, in the past, it seems kind of crazy. Let's just take like this time of year, you could basically qualify someone who who was on an extension of their business returns. You could basically be a year out or a year plus out of when they actually last filed returns to approve them. Now, what you have to do with self-employed is you need an updated year-to-date P&L and at least 2 to 3 months of the most recent bank statements. The reason being is with COVID, the agencies have said, listen, we want you to prove that business is viable and has still maintained their income levels. So you need their most recent tax return plus their year-to-date P&L for those months between, showing that they've made sufficient income, and the bank statements to show that they actually are making deposits. So some, but not all businesses make regular deposits. So we do have some leeway to go to say, okay, give me your last 12 months of deposits so that I can show seasonality. It's that type of business, but it's become very tricky. It's always very tough for the self-employed in any market, especially with changes like this, to prove your income and prove the ability to repay. It's a much heavier burden than what it was pre-pandemic. Let's put it that way.
All right. And Jackie, I'd like to see if that's the same for you. And also if you can kind of get into a little bit of, an isolated instance. Is COVID considered an isolated instance? Is it not? And if you could give an example of what is considered an isolated instance, that would be helpful.
Yeah, no, absolutely. I think, in terms of what Vince said, in terms of documenting particularly the self-employed, that profit and loss we need to get, it needs to be within 60 days of the note date. And yes, I know people get frustrated. Yes, they pack up their things. Keep your financials out, because documents that used to be good for 120 days are now good for 60 days. So your lender, whoever it is going to be asking for these updates. But, in terms of COVID, there are a lot of businesses that were shut down for a period of time, and people were receiving unemployment due to a COVID-related shutdown. COVID, the agencies have decided it is not an isolated incident. And the fact that, we're a year after COVID first shut us down, I'm hard pressed to disagree with them. So if there was a COVID-related layoff, we can't count that. We can't exclude that period. And we also can't, back it out of our calculation. We can't count the unemployment income somebody received during that time as income. So anybody who has fluctuating income, bonus income, an hourly employee that doesn't always work the same hours, we're going to need to average their income over that full 12 months, including that time that they might have been out of work for a period of that. So that's a huge difference from qualification.
And the as far as what would be considered an isolated instance, just to kind of give a little bit of grounding with that, can you give one example of what an isolated instance would be?
Yeah, absolutely. An isolated incident could be, if somebody was out on a maternity leave. While you might have more than one child, the industry considers that to be an isolated incident. You were out for surgery or an illness where you were out of work for a period of time and then you went back. That can be excluded in terms of doing that qualification. But if it's COVID related, it's not a matter of being fair or not being fair. It's just a matter of that we need to follow the secondary market guidelines in order to make the loan, to get a 30-year fixed rate at the rates they are now. You need to follow their rules. We don't make the rules, but we know the rules.
All right. And go ahead. Sorry.
Oh, no. So that was it. You could go.
Okay. Vince, just while we're on this topic, the payroll protection program, how is that, we're looking at what, up to 300,000? How is that affecting or considered during the qualification process?
It is where, and that's an important part of the P&Ls is we're looking at those, and I'm seeing businesses, and part of the problem with the issue with having businesses submit their P&Ls, many of them have never done this before. So, they have an accountant who takes care of the books at the end of the year, but they've never completed personally, I think you should, but they've never completed a P&L on a month-to-month basis before. So we're scrutinizing those and looking, and that money is added into their business and it's separated out. I can't remember the exact acronym. It's not PPP loan, but it's another acronym for it. And oddly enough, all the ones I see are about $149,000 because the forgivable limit everybody thought was going to be 150. So many people took 145, 148, 149.
149.9.
Exactly. I saw one of those too, Sandy. I saw one of those, and I don't blame them one bit.
Yeah,
Absolutely. But we actually have to back that out. So if I've seen some businesses put that in on an income line, and you just can't. It's not valid income. It's a technically a loan, even it's forgivable. I've also seen those assets try to be used as personal assets in a transaction. When you see a bank statement for down payment, you're like, wait a minute, what's this $125,000 in here? It's PPP funds. I have to back that out of your personal funds.
Okay.
And a few times it's really caused a major problem because that's not what those funds are for. I mean, if you commingle and I could back it out and you still have enough, that's fine. But generally, when you're putting that kind of lump sum in, it's not going to work. So that's really been the biggest obstacle with some PPP. Listen, if you need it, take it. Absolutely.
Right.
But it's just remember, and as Jackie said, the agencies, they're not considering this a singular event. This is an ongoing event. So they want to ensure, and all of this is meant so that you can demonstrate a viable ability to repay that loan over the 15, 20, 30 years that you're asking for it. And it's caused a lot more paperwork. It's caused a delay because we're reviewing a lot more.
As though we didn't have enough paperwork in this industry.
Yeah.
The volumes are up and the amount of work, what we need to review is up.
Yes.
Forbearances are another item that also, I think the CARES Act basically went out there and said, if you're having a hard time due to COVID, if you've been impacted, you can get a forbearance and you don't have to pay your mortgage and nobody's going to report you late. So some people were like, well, I'd be an idiot to pay my mortgage if I don't have to pay my mortgage. It's gonna be a challenge if you're looking to buy a new property or to refinance the property you have. That there are people who had a legitimate hardship. There are people that just got downright scared that, okay, it's March, the businesses is shut down. Oh my gosh, I'm not going to be able to pay. I can ask for forbearance and get some time off of my mortgage. I'm going to do that. And if somebody had a hardship, that's fine. What the agencies have said is that if you've had a COVID-related forbearance, you need to, that forbearance needs to be, those missed payments need to be gotten up to date, whether it's by a deferral, by a modification, by a lump sum payment. But then we need to be able to verify that you've made 3 payments post forbearance within 30 days of their due date in the month it's due. So I'd had somebody who had a forbearance, actually had to get all the way caught up on their mortgage, got caught up, and then listed their house and thought that they were going to sell it. And they'd had like 1 month since their forbearance.
It's not quite working that way, is it? No. Okay.
No, so it definitely was a challenge. But when I'm saying be upfront with your mortgage officer about what's going on, that type of information is something that, ultimately, yes, this loan is closing. They have to wait until March so that they're 3 months out of it. But had we known that information up front, there wouldn't have been quite so much.
Well, you can better counsel and advise, right? If you know the totality of what the situation is, then you can best counsel and advise, whether it's things that they need to do to rectify different packages that are available, right? I
Yeah,
mean,
no,
that's-
and I think that a lot of it is these are uncharted times, and some of the rules out there might not seem intuitive because they're like, well, if I can get it, why couldn't I? Well, because you're looking for a new mortgage, and in many cases, they're spending a lot more money. We are concerned that the loans are going to perform to expectations, which, our expectation is that you're going to pay every month like you promised to when you sign those papers. But things happen, and if you're upfront, it just makes the process go so much better. And from a transparency standpoint, we can let people know what to realistically expect.
Okay. All right. So now let's get into the different loan types. Okay. So, and we'll get into, I mean, there's other loan types aside from the ones that we're going to discuss today, but I want to really just kind of hone in on the key ones. 30-year conventional or 15-year, FHA. So Vince, why don't you want to start out with, I'd like to kind of just have a very brief on the 30-year, what qualifies a person, generally speaking, for a 30-year, what is considered a good FICO score, and along those lines, if you could kind of touch it on that 30-year, the conventional.
It's really about conventional versus, conventional conforming then versus government loans or any kind of New York bond loan. So if you can fit into a conventional conforming loan, we call it conforming 30, but you can do 20, 15, 10 amortization. But they're governed by Fannie Mae, Freddie Mac. They set the guidelines. Good credit score depends on really, your scenario. I mean, obviously the higher the better. If you can get above 760, that's great. You'll have the limited amount of what they call pricing add-ons. Real quick, let's just talk about banking 101. Okay. It's all about risk. So whenever you increase risk, you increase the fee. So Fannie Mae, Freddie Mac are all about risk. And the riskier loans are lower credit scores, higher loan to value. Okay, that's where you get into bigger risk models. People, don't have the equity, maybe haven't shown an ability to repay in as timely a fashion as they would like. So once you get below, 700, 680, those areas, your what we call our loan level pricing adjustments add up. So Freddie Mac and Fannie Mae are going to add certain fees to offset their risk. So the lower your FICO score, the higher the higher loan of value you borrow, your credit adjusters, your loan level pricing adjustments are going to go up. So it's going to be more costly to get that financing. That's where maybe Jackie can talk about, the Govy loans, but with just conventional conforming, if you can get in that bucket, it's good to be there. They do have some first-time home buyer programs in conventional. You've got Freddie Mac has a home one and a home possible. And I can't remember what Fannie's program is.
Ready?
Home ready. Yeah, there you go. Thanks, Jack.
Yeah.
So they do have some of those where you can go to 97% financing. And they limit the amount of adjusters, loan level pricing adjustments for first-time home buyers. So they don't, they make it a little easier for you. But that's really where it is. And that's why knowing your scenario, trying to keep that credit score as high as possible. You don't need 20% down. Mortgage insurance is not a bad word. It allows many, many people to get into properties. But, again, you can do conventional financing, 660 and above for the most part. Again, the lower you get on credit, the more expensive it gets, but you can still get those done.
All right. And Jackie, want to hit on
Yes.
FHA? Let's hear about FHA. What's the credit range generally? And also I'd like to know, is there like a credit score where a person is really it's just not happening? So, I mean, FHA as well as is there a place where it's just
back in the day, and I'm talking 15 months ago,
That's like
you know,
a decade.
Right.
a credit
like-
score of 580 did not necessarily put you out of the game. That even with FHA, that right now, even FHA, you really generally need to have at least a 620 FICO score. But normally the biggest, in terms of the typical borrower that I'm seeing going with an FHA loan, there's a number of issues that are going to make that the better option. One issue would be if they'd had credit events. So, if I'm going for a conforming loan, I can't have had a foreclosure within the past 7 years. I can't have had a bankruptcy within the last 4 years. That limit for FHA, it's a 3-year seasoning. So for a lot of people who went through the bubble, got in over their head, values went down, their income went down, they couldn't get out of a property, that there are still people that we're running into that had short sales, foreclosures, bankruptcies, due to, and a lot of it was a real estate crisis still. So a lot of those borrowers, FHA, VA also might be the best option. At the lower credit scores, the FHA has a standard mortgage insurance premium. They have both the upfront mortgage insurance premium that's financed, and that's 1.75% of the amount. And then they have the monthly mortgage insurance, which is 0.85 generally. The borrower is going to be.
These are all numbers as of today. These numbers, what you
are
just
today,
said.
yeah.
I want to just.
So everything is subject to change. But if you've got a 640 credit score, even if you get conventional approval, private mortgage insurance is going to charge a higher premium to insure that loan at that high LTV for a borrower with a low credit score. So that's going to make FHA a better option. The other people that we see with going FHA is that, typically, they say 43% DTI is, the standard. Conventional, you can get up to 45 all day long. With a good credit score, you can often get, as high as, so long as you're under 50 and the credit score is pristine, you can often get that. But once you go above 50 debt to income ratio, the only game in town really is FHA, and you will be able to get a debt to income over that. Now, I don't recommend trying to live at a 56% debt to income ratio, but there are reasons why you might do that. Perhaps you have somebody, in the household, you have a partner who maybe doesn't claim all of their income, who maybe has, there's a reason why they can't be on the mortgage, but they are contributing towards that household income. So that's part of when you're talking with your mortgage officer as to how to structure this loan. Maybe it makes sense for just one borrower to be on the application and not the other, and maybe FHA makes most sense. But what I would say is, don't go in and say, I want a conventional loan, or I want this type of loan. This is my situation. The mortgage officer has experience in terms of what makes most sense for different borrowers and would be able to recommend the program that's most appropriate for that borrower. With condos in this area, I'm going to say FHA and condos don't go together.
No, I'm gonna say they don't too.
Yeah, so so some of that, and that's why it's important also to talk with your mortgage officer, because if your mortgage officer is telling you you need an FHA loan, that means you can't really get a condo in this area. You could get a PUD. They look like a condo. A lot of those townhouses look just like that, but they're set up as a planned urban development, and you can get financing on that. But that's where that partnership between, working with the mortgage officer, communicating with the realtor in terms of what it is that you need, because you'd be very disappointed if you were showing a borrower a condo and they could only get an FHA loan, and
Right. Back to square one. Yeah.
Yeah, and then you have to go back to the beginning. But I think that in terms of structuring the loan is be upfront with all the information and the mortgage officer will be able to take a look at that and make appropriate recommendations as to what product would be best suited for your individual situation.
All right, now I'm going to just, I want to touch lightly on this piece, the new construction piece. So there's the two different avenues, as far as I can tell. One is buying into a subdivision, right? An existing subdivision, where you have a builder and you're picking your lot and you're going down that road. And then the other road is someone who is buying raw land or already has purchased raw land and wants to build from the ground up. So just, again, real brief, touch on these two, but someone coming in to buy a subdivision, what type of a loan is that?
That's just conventional FHA. Vince, take it away.
I was throwing it to you.
Oh,
Go ahead, Jackie. I'll get Vince on the next one.
okay. Yeah, if you're getting the end loan, the builder is going to be taking care of the construction, then it's just a regular traditional mortgage. So you're getting that end loan. I would say the difference is that if you're going into contract with a builder, that you do have a requirement to get your commitment, which is your firm approval that everything has been reviewed within a set amount of time. That typically that's 30 to 45 days after you go into contract. You need to provide a written commitment to lend to that builder, that developer, and then they are going to get the financing. So sometimes people think, well, gee, my house isn't going to be built until 2022. Why do I need to apply for a mortgage now? You need to apply for a mortgage now because your builder is not going to be building the house of your dreams if you have not been able to provide that written commitment that you qualify for a loan. And yes, you'll have to keep on updating things. And yes, that credit's going to expire. So you're going to need to be go the straight and narrow for this term of construction, that don't go out and buy big cars, don't stop paying your bills. But you'll be getting that commitment for that loan. And then, it's going to be in process for a while, but when construction is complete, then you will close on that loan. You're not paying any interest. You're not paying anything on the construction loan. You don't own the land until it's done.
Okay.
And you go to a conventional closing.
Okay. Now, you brought up an interesting point that I don't want to sidestep. Actually, I want to draw attention to. When you said, don't buy this, don't buy that. So one thing that came out in conversations that we've had was that, there can be potentially some an aptitude to buy that new car after you've gotten your commitment and your closing is in another week and a half. You've got the closing date scheduled. It's a done deal. So let's go buy that car now. Let's go buy all that new furniture. Let's get hog wild. Yes?
No.
No?
No.
Why not, Vince? It sounds like a great idea. I want a new car to drive in my driveway. I need new furniture. What's the problem?
Because remember, you have a commitment, but that commitment is subject to ensuring that there's basically no material changes in your income, your credit, or your asset viability. So, we laughed about this, so we chatted a little bit. I used to tell all my customers, listen, you could walk by the furniture store and look in and pick out what you wanted, but you couldn't walk through the door, because what we have to do is we have to ensure that there's no undisclosed debt at the time we deliver that loan to the investor. So certain lenders handle it differently. We actually do a credit monitoring that we pay for throughout. So we'll know if you have we want to know as early as possible if you bought the car or if you bought the furniture, because that could affect your debt to income ratio. And when we deliver that loan to the investor, they're going to see inquiries and want to know, okay, what happened? Because it's a timestamp. At that moment in time when we deliver, we've got to deliver what we say the situation is. So inquiries are going to be questioned up until the end. Some lenders will repo or do what they call a soft pull before closing, and they'll see if there's any undisclosed new debt on it. They won't do a full credit report repo, but a soft pull to show, is there any new debt? Is there any new inquiries? And we've many times asked, 10 days, 2 weeks before closing, hey, you've got these couple of inquiries here. What do you, oh, I was, and then you just get, either an explanation or you have to get the actual credit docs. If somebody got a new credit card or they got a car, a lot of times what you'll see is, hey, I traded in, I returned my lease and I got a new one and the payment's less. Okay, that's great. But now we need the paperwork to show that you actually returned your lease and then the new one. So it adds some complexity. So, hey,
And complexity can mean delay in closing. Complexity equals delay a lot of times.
I'm telling you that, if the car breaks down, I don't want you to use Uber for 2 weeks. I want you to get a new car, but we need to just have a discussion of what the plan is. That way I can tell you what documents I need up front so we can stop that delay and be prepared.
And this all comes back again to just this constant communication that's going on with your loan officer, right? Is all the way through. Now, another interesting point with this that you're kind of touching on, and Jackie, I'll throw this to you, as far as, okay, so you say to me, you can spend X on this house. Now, there are certain things that I would imagine when you're looking at, you're looking at these numbers, you're looking at income, debt to earning, all these things, but these things don't factor in if maybe a person enjoys certain hobbies that maybe are expensive or likes to vacation or different things that, may not, actually be on a piece of paper. How do you advise clients when it comes to that?
I think it's important that what mortgage you qualify for is helpful, but also what sort of payment you're comfortable with. And, so if you have somebody who says, you know what, I'm comfortable with a $2,000 a month mortgage, but I want to live, locally, maybe Arlington School District, where you're hard pressed to find a house with taxes much less than $10,000, you're not going to be able to get that $500,000 house on $2,000 a month. Unless you have a really big down payment. So some of it is, what you're comfortable with paying and what you qualify for can be two different things. And to honestly look, if you're spending $2,000 a month on childcare, we are not going to put that in your debt to income ratio, but you need to, if you need to have childcare, you need to know about that. If you have children in college that you're supporting and you need to be paying, giving them money to live and to do all those other things, which I think Vince and I both go, oh yeah. My last one, my daughter graduated in May, so I don't have that anymore. But there were a lot of expenses that are associated with that. So I think that's something that a buyer should take into account because nobody wants to be house poor. That you want to know that you
that's a horrible thing. I've had clients where it's like I advise clients this way, because I've seen especially during the housing boom and the burst in the 2000s where people were really stretching themselves. Right. And I counsel my clients, to really pull back on that because, you don't want to get into a house and be buying all plastic furniture unless you want to buy plastic furniture. And if you want to buy, that's fine. But if you don't want to buy plastic furniture, you don't want to be in a situation where you have to. And that's not, a great feeling or to feel like you're literally like you're a slave to the house. That's not. So really, it is important to take a look at not just what the bank is willing to allow as far as a mortgage is concerned, but really taking a look at your lifestyle and, your expenses that a bank may not consider and really, honing in on that and finding a number that really does feel most comfortable for you. I mean, that's really the responsibility of the buyer to take that on for their personal finances.
I always worry about somebody who's never had a housing payment and has not been able to save any money. And they're looking at getting a mortgage with a $3,000 a month payment. I'm like, you've never put away $3,000 a month. And you still have to heat the house. You still have to pay your car insurance. Right. You still need to eat. You need your food. All of these things, you really need to think about what it's going to cost to live in that house. And, what is it going to cost to heat? What is it going to cost to cool? What is it going to cost to?
Right. Which they have to go with approximations because obviously that can vary, and even when they find a house that they like and they get, let's say they get, the past year of electric bills or heating bills. I mean, that also is very subjective, that it varies based on the owner's use. But yeah, this is an important point that it does need to be considered. So to wrap this up, As far as takeaway is concerned, I've got one, know the negatives on your credit report. Just know what's on there. Get to know your credit report. Be truthful and full with information to the loan officer out of the gate. It'll keep things moving and keep the process smooth and keep you looking in a realistic realm as far as a house that a price point that really makes sense for you. I've got the debt. Do not make major purchases just prior to the closing. Avoid that completely. You really want to keep things right to the end. Is there anything else that either of you would like to add to that?
Yeah, I would say not just major purchases, but if anything changes, to be upfront. We've had borrowers who switch jobs right before closing.
Or lose their job.
Hurt. I've had borrowers who have retired and not told us. And we go to do the final credit, the final verification of employment. And, you're like, oh yes, Mrs. Smith, she's so wonderful. We're so going to miss her. She just retired.
Yeah, no good.
That type of thing, do tell us, because we need to know. And, I think that's the biggest thing, is just to be open in terms of any changes that are going on in your situation that would impact mortgageability, your ability to qualify for the mortgage.
Well, Vince, Jackie, I appreciate your time. Thank you for sharing your knowledge, your wealth of knowledge with us. And if you like this, please throw me a like or subscribe to the channel. And thanks again for your time. And I hope everybody found this informative. Jackie, Vince, thank you very much.
Thank you,
Sandy.
Take care, all.
Bye.